Hi, and welcome to this week's Market Pulse video, taking a look at the major stories that have impacted the market so far in the last few days and may well have an impact moving forwards. Well, it wouldn't be one of these videos without starting off with a good old Great British Pound. And cable, pound against the US dollar, faces a key hurdle at the moment, along with all the other things that are going on. We saw the rate struggled to clear 1.1500 earlier in this week, and in fact corrected slightly lower, with a bearish trend line forming around the 113 mark. Currently we're looking at trading around the 1.126 level. We did see that wave of recovery with an FXOpen high near 114.96 just earlier this week, but obviously plenty of news been around the last few days that's had a direct impact on sterling. So what are the key levels to look out going forwards? Well, we certainly saw some support around the 110.20 mark, and below that we'd look to see more support around 109.50, with resistance. Normally we're talking only around 111.20, and we were looking in fact for an upside break above 112, which is currently where we're at, above that 112. 112.80, bit of a key level there. That's where we're looking to head towards. Expect some resistance around the 113 on the nose figure. Fair to say it's choppy waters for sterling. Various other stories, and we're going to touch on one in a moment. But today, Thursday, was a little bit of quietness in terms of the US dollar due to inflation reports coming out later, which we would expect to see increased volatility a little bit more. Right, now we're going to look at the effect some of what's going on in the markets having in terms of professional traders. Mentioned it briefly earlier about volatility and how we're expecting to see a little bit of an increase later on in today's sessions. But professional traders seem to love market volatility. Obviously, we've seen a sustained devaluation of the pound and the euro, which has brought back one thing that we haven't seen for some time, which is volatility. Now, the pound, as we've discussed on many occasions, has tanked in comparison to the euro and especially the US dollar. However, this volatility, this sort of whipsawing movements, has definitely increased interest in FX trading, with a return in this volatility that we haven't really seen levels like this for more than 20 years. In fact, if we try and put it into some real figures, Euronext, which is a European electronic trading venue which incorporates FX as well as several other markets, indices, etc. Euronext FX, a specialist FX platform, saw 30% more trades in September 2022 compared to the year before, September 21. And in fact, monthly turnover was up to $533 billion US in September. Now that compared to $452 billion in August, so sort of around an 18% increase. On top of that, we're seeing that interbank FX volumes are at multi-year highs. So whilst the economic outlook is bleak, certainly in the UK and in Europe, the currency markets are well and truly alive. Volatility does bring with it its own issues, so remember your risk management techniques if you are going to be trading major currencies over the coming days. Don't risk too much, keep it sensible, and most importantly, ensure you can enjoy your trading. Now we're going to look at some of the intervention that's going on in the markets, or possibly going to go ahead. And then we're going to start again back in the UK, and we did see the pound getting dumped just the other day as the Bank of England signalled that it was to pull the plug on pension fund support. Does that mean there's going to be a run on pension funds? Well, it's definitely a possibility. But what happened was the Bank of England introduced a £65 billion bond buying programme. Now, these are basically loans from the government or to the government in return for a rate of return. These are heavily traded by pension funds in the UK. Now, the Bank of England has said that level of support, the £65 billion buyback programme, will end on Friday. In fact, Bank of England Governor Andrew Bailey said on Tuesday that pension funds must get their rebalancing done, and done now. In other words, change the makeup of what they're investing in slightly. Off the back of that, we saw traders dumping pretty much across the board pound, and we saw it fall to around 109 versus the euro. As I say, it's been a choppy market, so we've seen a slight recovery there. But it's clear the messages are now starting to become slightly mixed. Apparently, during private conversations with bankers, Bailey turned around and said they may well extend this support programme. So nobody's 100% sure. Again, reaffirmation earlier today, they are going to stop it tomorrow. But are they going to let the pound tank? Are they going to let the UK markets and particularly pension funds suffer by pulling out quickly? Certainly there's a lot of internal reports around that suggest that the pensions industry as a whole is nowhere near ready to lose its Bank of England support. So what's going to happen to pension funds? What's going to happen to sterling if and when they do pull this level of support is yet to be seen. Keep your eyes on the market and look perhaps at other opportunities. If pension funds are coming out of gilts and bonds, where are they going? Will that increase demands for other types of markets? Keep your eyes peeled. Finally, let's have a look at the Japanese yen, and this ties in with market invention that we were just talking about. Now we've seen this way, the Japanese yen is testing 1998 lows, currently close to 147 yen against dollar against the yen, and that level was last recorded 24 years ago. Okay, so not looking happy for the Japanese yen currently. We're currently trading around 146, 75, 76. So in that sort of region. Finance Minister Suzuki hinted at re-intervention on quite a large scale potentially on Wednesday at G7 financiers meet in the US. It's been a little bit quiet again today. We have got US inflation reports due, which should increase volatility, and obviously that could well have a direct impact on the Japanese yen. Now, charts are showing a strong trend line, which has mainly been caused by differing policies. In the US, we have a very aggressive interest rate policy, and obviously they're dealing with inflation as well. Whereas in Japan, they seem to be taking ultra-soft monetary policy. 146 was resistance, but we could now well see that turning into a support level. Are the Japanese government or the Bank of Japan going to intervene, as they've hinted that they will do? Our previous intervention that we saw around 141 seemed to fail. In fact, 141 seemed to turn into a little bit of level of support as well. So what's going to happen now? What level of intervention do we think the Bank of Japan is going to take? And is it going to have any direct impact? A lot seems to depend on what comes out of the States in terms of these inflation reports. Keep your eyes peeled. As I said earlier on, with volatility where it is at the moment, remember your risk management skills and put them to good use. Good luck with your trading for the week ahead.